Hi there, it's Bill with Smart Trades. It's Saturday the 10th around 2 o'clock Pacific time, and today I'm going to do something a little bit different. I'm going to take a look at, actually do a tutorial on, first off, things that don't work in the market or don't work consistently. And you often hear people talk about various indicators and saying that it's a given that if indicator A does this or that the market's going to follow, or that it has a high probability of following. And in fact, there's a lot of misinformation out there. First off, on the top of the list, I wanted to use the basic stochastic indicator. And I've actually tested this years and years ago, but here's the TradeStation test summary going back about 50 years on the simple 14-bar stochastic indicator. The net profit, this is assuming 100 contracts or 100 units of the S&P cash, which obviously you actually couldn't trade, but it gives you a pretty good idea, and we have the longest amount of historical data there, so that's why I chose it. Your net loss would be $168,000 over the last 50 years, and about 60% of the trades would have been losers. Worse than that, the actual drawdown would have been $194,000, and this is using the S&P cash, where, as I've stated before, there's a lot of problems actually with the opening data. So your fills in reality in the futures or the spiders, for example, would probably be a lot worse. And in fact, I've tested that, and indeed they are much worse than that $168,000. So if somebody tells you the stochastic crossover is meaningful and it, somehow indicates a probability that the market is heading in a particular direction, don't believe it. In fact, you should run as fast as you can from that person's advice. One more to look at, very popular indicator, the MACD. And this will take a second for TradeStation to actually do the data. Again, going back about 50 years, you can see the various crossovers. And here's one of the problems, is that you oftentimes at a turn will get whipsawed, and it'll take several trades to actually get on board. And let me show you the actual data here. This is, again, going back 50 years. You would have had a net loss using the standard MACD values, and taking each and every crossover for the last 50 years, you would have lost about 65% of the time, 35% winners. Your net loss would have been $72,000, again much worse in actual trading, and your worst drawdown would have been about $133,000. Now, a lot of folks will tell you, well, it's not the MACD crossover, it's the divergences. Well, the problem with the divergences, just like the MACD, is they give a lot of false signals prior to the actual turn. In retrospect, they all look great because eventually, divergences more than likely are going to work. But a good example, and I'm not going to go back and take your time to show you, but trust me, there were divergences galore from about 1993 against both the S&P and the NASDAQ, and the market, more than tripled or quadrupled in some cases. The NASDAQ, it went up about 1,200% from where those divergences started, both on the daily and weekly charts. So, and those are on MACD, stochastics, you name it. Those divergences got blown out. So again, they look good, divergences, and I do actually look for divergences in volume and breadth, but MACD divergences, they happen too often, they happen too early, and they will give you so many false signals. In my opinion, they're not worth even watching. Now, one more popular thing to look at is the 200 bar moving average, and this is an indicator that I watch to some extent, but and in fact, let me just show you here, it actually has made money over the last 50 years if you just took each and every crossover. The problem and the caution with the 200 bar moving average is when we cross over, we tend to whipsaw over it. In fact, the worst case of consecutive losers was 19 consecutive losers in a row. And you have to ask yourself, if you've had 19 consecutive losers on a method, are you going to take that 20th trade? The answer, in my opinion, for me, I can tell you, is no. You're just not you're gonna give up on the method before then. And the net profit, 119,000 over 50 years. Okay, not that great, but again, only 29% winners. And the flip side to that profit number is that the losers, in terms of max drawdown, was $70,000. So in other words, on a $100,000 account, you'd be down to $30,000 at some point if you had traded it this consistently over the last 50 years or so. Anyway, those are sort of the big three that you hear about all the time. While we're at it, let's do a quick update on our Elliott wave analysis. Again, double zigzag down. We think this is a B wave within a double zigzag, the current rally we're in. We came very close to the 1075 target on the S&P cash, actually hit it exactly on the futures. In my opinion, it looks like 5 waves up. We're probably going to have a bit of a corrective decline, perhaps down to the 1040 level, maybe not that low, hard to say at this point. And then another rally up. 1090 looks good. That's about a 70% retracement of this decline. If you'll notice, the prior rallies back against the zigzag pulses down have all been in that 70% area. So the fact that that coincides with our downtrend channel, it's also an area, a previous area of congestion here. You'll notice that we've got holding closing lows here, and then we have resistance on the way back up. So a revisit of 1090 would actually be perfect. As always, we'll take it one step at a time and see how it goes. Anyway, thanks for watching and have a great weekend.